My name is Li Xinyang. I'm going to be the MC of today's event. I'm pleased to introduce Ms. Linda Sim. She's from Business News Network, which is the largest business TV station in Canada and also the media partner of GCFF.
Thank you so much, Sean. Ladies and gentlemen, we're really pleased to see you here today. I mean, there's no question that China is becoming one of the biggest growth industries, growth economies in the world. Indeed, at BNN, we have a lot of discussion about whether a downturn in the U.S. economy matters as much, given the kind of growth that we're seeing outside North America's borders. And we know that growth is mainly being, as I say, propelled by what we're seeing in China. So this is a terrific opportunity. I think we've got the China Investment Symposium here. And really what we want to do is explore the connections between the North American and the Chinese financial markets, which of course means bringing our businesses closer together as well. So I hope you enjoy the afternoon. We're going to be talking, as I say, about really promoting a mutual understanding and communication between the Chinese and the North American investment community.
Yeah, right. As no one would deny the economic miracle that China has been achieved so far. But right now, there's still many people talking about China Bible. Whether the Chinese strong economy and stock market continue in the next few years or could crash in the near future is a really hot topic. We believe that with the help of next four presentations, all our audience would have a deeper and better understanding of such issues.
Okay, well, we'd like to get things going right away. Our first presentation is Mr. Hu Zhong. I hope I'm saying that correctly. Mr. Hu is currently the research manager of Merchant Securities Hong Kong Company. Prior to that, he worked for ING Investment Management, Asia Pacific, and he's got a lot of experience in the industry in the region, and he has also worked for the People's Bank of China and China Insurance Regulatory Commission, so he certainly understands the governmental organizations as well. So please join me in welcoming Mr. Ho. He's going to talk about understanding QDII and QFII, the latest talking point in the investor circle.
Good afternoon, ladies and gentlemen. It's great pleasure for me to be here to talk about China with the people who are interested in investment in China. My topic is the outlook of China's economy and about equity markets. The three topics I'm going to cover is the first one is current economic situations in China and what's the outlook of this economic growth. Will it sustainable and how the macro tightening policy are going to evolve in the coming 6 to 12 months. The second topic I'm going to touch is about China's equity market. As Chinese companies are listed mainly in China and Hong Kong, what's going to happen to this market? What's the main drivers and engines of this equity markets continue to perform? Is it overvalued or is it still a healthy growth in the coming 5 to 10 years? The third topic I'm going to talk about is benefiting from the QDII and the QFII program. QDII stands for Qualified Domestic Institutional Investors, which allow Chinese domestic investors to invest outside Chinese mainland market. And QFII stands for Qualified Foreign Institutional Investors, which allow international money to legally invest in China's A-share market. This is the market inflow. This is the money inflow and outflow out of China. It will have a tremendous impact on both international financial market and especially Chinese A-share market. Let's have a brief overview and review what has happened in China's economy in the past couple of years. And let's look forward what's going to happen in the next 6 to 12 months. Oops. In this chart, I have charted the GDP growth together with the CPI inflation numbers. You can see from this chart, the Chinese economy, this round of economic boom starting from the end of 2002. It was briefly interrupted in the April of 2003 by SARS, but the economic growth are very strong, still very strong in the past round of economic growth. Starting from the end of 2002, China's economy grew at on average about 10%. average growth in the past 5 years. If you go back to the year when China first opened its economy to the outside world in 1978, basically Chinese economy grew at 10% for the past 30 years. If you apply the rule of 72, which is the years you need to double your asset size, basically that is to say China's economy basically will be doubled in 7 to 8 years. Is this going to be sustainable? Let's go back. Let's look at the target set by the Chinese Communist Party, which has just been completed this week. In the 17th Parties Congress, the party said the target of economic growth is by the end of 2020, the GDP growth per capita is going to be increased by 200% compared with the GDP per capita in the year 2000. That is to say, if you divided the 72 by 10, that is the party have set the economic growth target by 7 to 8%. So when you see an economist, be it Chinese domestic economist or international economist, making a projections of saying China's economy are going to slow down to 5%, the probability it is wrong is big. So once the party set the target, the probability is high, the country are going to beat it instead of underperforming. So basically we should be, from a party's perspective, Chinese economy continue going to grow and no dramatic slowdown in the coming years. This is the overall numbers. So what happened to this component? Basically, if we look at the economy, we look at 3 parts: investment, consumption, and export. Let's look at each component of the economy separately. This is the so-called investment part of Chinese economy. In China, we call it fixed asset investment. In the past 20 years, China's fixed asset investment the average growth rate is around 20%. And basically, investment accounts for 50 to 60% of China's economy. So in the Chinese economic world, basically, if the investment growth is around 20%, the economy will not slow down dramatically. The latest number for the fixed asset investment is 26%. And since there are a lot of projects still underway, there is the West development, there is also the rejuvenation of industrial area in China's northeastern area. So we are still have a lot of projects to complete. So the economy have sustainable growth drivers. This is the consumption. In China, the main consumption indicators is the retail growth rate. This is at the left-hand side of this chart. On the right-hand side, we have the disposable income for the urban area, for the urban people, and cash income for the rural people. Both the income, dispensable income, and the retail sales growth at around 10%. Although it's far smaller than the investment growth, but still it's quite decent compared with the retail sales growth rate of the other countries. If you look at China's economy as the whole system, basically the companies, the corporate profit grows the most. On average, the corporate profit growth in this round of economic growth is around 20%. The physical income growth, which is the part that could be part of the government, the physical income growth is around 20%. The personal income growth is about 10%. So basically, in this round of economic boom, corporate profit benefit the most, followed by the government and then the individual consumers. We view this trend will continue to grow, and we believe that the retail consumers are going to benefit more and more as economic growth strengthens in the coming decade. This is the trade. On the left-hand side of this foreign trade, I have charted the trade balance, the export and import. If you look at the one number which the focus is the trade surplus. If you look at trade surplus, China have recorded the highest trade surplus in the past year. And this year, we are expecting the trade surplus continue to surpass last year and be the largest trade surplus since the People's Republic was founded. This trade surplus is the main reason of the liquidity in China, because Chinese central banks, to keep the foreign exchange rate stable, Chinese central banks have to sterilizing the liquidity coming out of trade surplus. So this is why so much money flowing inside China. Trade surplus introduce a lot of liquidity, and this will finally impact on the price levels. this chart, I've charted CPI indexes. If you look at CPI chart, which is basically to say that CPI have rise a lot. The latest number of CPI is about 6 to 7%, 6.2 to 6.5. That is the highest level in history, if you look at here. But if we evaluate the pool, which the new indicator is the core CPI, which is the CPI number is exceeding the CPI is quite stable. So this rise of CPI, the consensus in Chinese economists circle is that this kind of CPI jump is not sustainable. It will come down gradually by as late as the beginning of next year. So basically, the CPI do pose a threat to the Chinese economy, but since Chinese central banks have noticed this rising CPI, we feel that the timing will continue to come because of the CPI, but it will not cause overheating of the economy as long as the Chinese economy is exactly to address the issue. The left-hand side is the right-hand side. I also charted the PPI and the CPI. If you look at CPI, it's rising, but the PPI, which is the upstream of the whole economic crisis, is coming down. So basically, that's the argument why we believe that this CPI hike is not sustainable in the coming months. Liquidity. We have saw a lot of tremendous price hikes, especially for the non-triple items. Here I have charted the housing price index and stock market performance. We see the reflations everywhere in China's domestic market, especially for non-triple assets such as real estate, basically cannot trade real estate in China, and also the stock market. Here I have charted Shanghai Composite Index because China has a very capital account. International investors cannot directly buy into China's business, so the stock market is still a non-triple asset. If you look at the starting from July 2005, both the housing prices, although we have several rounds of tightening, the stock prices have risen dramatically, and the housing prices are still good, and the stock prices at the end of the day are still rising. Stock market is a typical reflection of how asset markets reflecting the Chinese not couple round of tightening. Here I have charted the Shanghai Composite Index. This blue line is the index performance. Is the first round of tightening. Here above the blue line I have put the date of required reserve ratio increasing, and below it I have charted interest rate hike. Basically, in this round, we have 1, 2, 3, 4, 5, 6, 7, 8. We just have another required reserve ratio height. Basically, we have 8 required reserve ratio for 8 times. And this is the highest level, 20% in Chinese deficit reserve. We also have 1, 2, 3, 4, 5, and 2, 3, 4, 5 rounds of interest rate hike. And people are expecting another, at least one time, interest rate hike before the end of this year. So basically, here, required reserve ratio height and interest rate height doesn't contain Chinese stock market increase. So you can see how strong the liquidity, how strong the Chinese market are performing. What's going to happen in the next 6 to 12 months? This is maybe one of the most important issues for both international investors and domestic investors in China. Here we have a couple of policy initiatives we're expected before the end of this year and maybe the first half of next year. We are still expecting renminbi continue to appreciate. The government policies are going to appreciate renminbi by 3 to 4% each year gradually. So if you look at the renminbi appreciation starting from July 2005, from July 2005 the renminbi appreciated gradually by 8.8%. And the expectation is that the renminbi are going to appreciate 20% for this round of economic boom. So basically, renminbi appreciation are going to have another 2 to 3 years to go before the market have new expectations regarding the currency trend. And at least one more time interest rate hikes within the year. I write this presentation before the People's Bank of China make their decisions. So it has happened. One two more required reserve rate hike, major tightening of loan and credit. Basically, China's central banks have the authorities to let the commercial banks to limit their loans, their loan growth, and to limit their money supplies. The issuance of special state debt to set up state forex investment corporation. This is basically the government sterilize all the foreign exchanges and let the foreign investment companies to export all these monies to the outside market. And the other measures are continued reduction of export tax rebates. You may have known the Chinese government have reduced the tax rebate of several non-competitive industries to prevent the trade surplus continue to grow dramatically. And one of the last policy initiatives that may happen is the strict approval standards for industries that are high on energy consumption. The government have put the harmonious society the most important priorities of this session for the government. So the energy consumption industry may suffer in the stock market. That is what has happened and what is going to happen in the past and in the future 6 to 12 months. What does this mean to the stock market investing in China? There are a couple of markets that you can get exposure to China's companies. Here we have a few of them. Well, in China we have the A share, which is basically China's Shanghai and Shenzhen stock market. The flavor is more of a Chinese flavor instead of international investors' flavor. Basically, all domestic investors have the right to invest in the A share market. And B share is initially for the international investors in Shanghai and in Shenzhen, but it is now completely open to the domestic investors. So the flavor, because of strong retail participants of domestic Chinese investors, the flavor of the B share market is basically a Chinese flavor. For the H share and red chips companies are the companies listed in Hong Kong Stock Exchange, but the investors are mainly international investors. So it's basically Chinese companies, but catering to international investors. Besides that, we have China ADR and other companies listed in the US, and also other companies listed in Singapore, London, Frankfurt, and maybe Toronto. So basically, if you want to get exposure to Chinese, to add some Chinese flavor or emerging market flavor, you could choose different markets to play the China growth story. You can choose the market you're familiar with, and so that you could benefit the most from this growth. Basically, if you look at Chinese equity market, we got one country, two stock markets. Basically, two major markets of Chinese company listed is A share market and H share market. They have the most listed companies, have the biggest market cap compared with the other companies listed in the New York, in the Singapore, and in London, Frankfurt. A share market is mostly for Chinese domestic investors and the most susceptible to Chinese liquidity boom. I used to be a fund manager myself in China's A share market. Basically, if you look at China's A share market and that of H share market, the mentality is, although it's the same, but we do have differences. Chinese domestic A share market rely more on more information than the international fund managers. So that could partly explain why the performance of the A share market and H share market is so different. Although the difference is converging, but they'll continue to be exist in the coming 6 to 12 months. H share companies are the Chinese companies in Hong Kong and accessible to international investors. So basically, if you compare Chinese companies listed in Hong Kong, basically you are comparing the companies in Hong Kong and Singapore, in Tokyo, basically across the region. So Hong Kong is different. Although the company is the same, but the valuation, the theme is somewhat different from the domestic A share market. For both the A share market and H share market, our view is still the basis for both markets being solid. Today, in these days, a lot of people are talking about the bubbles for the emerging market. Basically, if you want to add extra risk and the return to your portfolio, a lot of people start to look at the emerging market And then the next step is to look at the BRIC countries. And the BRIC countries, you look at Brazil, Russia, China, and India. My personal view is that the BRIC countries, each country offers different perspective for international investors. Basically, Russia and Brazil are resource play, and China manufacturing, and India are exporting their service capabilities. So you are looking at different perspectives if you focus on these BRIC countries. For China, I feel one of my most confident market I have in my career. I have listed the reasons why I'm still bullish for these two markets. In the long term, I call the factors engines, and short terms I call them catalysts, which is maybe, although it's short term, but it is continue to drive both China's A-share and H-share markets going up. In the long term, we see the long-term engines are including consumption, demographics, and urbanization. I think are the most dramatic long-term promoters of China's equity market. The short-term catalysts, I saw a strong profit growth, renminbi appreciation, new investors joining, 2008 Summer Olympics are all short-term catalysts for these both the A-share and H-share market to perform. I personally especially like H-share market the most compared with the A-share market. Let's go one by one to examine these engines and catalysts. In this chart, I have drawn two graphs. The first one is the per capita of GDP, and the other one is the income, the disposable income of Chinese urban residents and rural residents. If you look at the Chinese per capita income, starting from the year 1980, that's the year when China began to open up to the outside world. China's GDP growth is basically, GDP per capita growth is very strong in the past 20 years, about 20 to 30 years. And also, the disposable income of both the urban and the rural area is also rising dramatically. Here we can see the gap between the urban and the rural area is expanding dramatically. This is where the new policy initiatives, which called Harmonious Society in this party congress, has been reaffirmed. That is, the party's intention is still to shrink the difference between the urban residents and the rural residents. So you're going to see a lot of policy initiatives encouraging people to go into the rural area to set up companies to bring new growth opportunities. So one of the themes that China Merchant Securities are going to encourage is to find companies that have very strong network in the countryside. Because in the countryside, you have, although you have relatively low income people, but the consumption is very strong. The consumption urge is very strong, and they are going to buy more products if you have very strong presence in there. This is one of the engines, that consumption. China has 1.3 billion people, and at the end of the day, this 1.3 billion people are going to be consumers. So although each consumer are going to, even if the consumer spend little money, if you time that by 1.3 billion, it's going to be a very big sales growth. So basically, consumption are going to be the first engine that drives the corporate profit, continue the growth, that will be providing a very solid fundamentals for China's stock market. The second one for China, why we are bullish for this Chinese market, is the demographic dividend. China have a relatively young demographic population. Basically, here I have charted the Chinese population are concentrating on around 35 years old. By the end of 2015, most people are going to be in this working area. Basically, baby boomers are into the golden age. It is this population, the composition population, that's going to be very productive. They'll spend less than they have earned, and they're going to channel all the money they have earned into the equity market. And also, here I have another chart that's saying that demographic dividends are going to continue to rise before the year 2015. The third engine we see is the urbanization. In the past, the opening up policy starting from 1978 have driven the urbanization growth very fast. We are going to see this trend continue to grow. More and more people are coming, have been liberated from rural farmland and come to the city. These have driven both the fixed asset investment, consumption, and a lot of other consumption needs in China. This will be the third engine that will definitely continue to contribute to the Chinese economic growth and profit growth. Short-term catalysts we see that continue to drive this market. The first is strong profit growth. There are a couple of indicators that you could look at the China's corporate profit growth. The first one is Chinese Statistics Bureau have released monthly above-size industrial corporate profit growth month by month. The latest number for the first half of 2007 is the average corporate profit growth grow at 43%. This is the first indicator. That is very strong if you compare that with the listed companies of other markets, 42% on average. If you look at listed companies, the Shenzhen Stock Exchange and the Shanghai Stock Exchange have released their numbers on the listed companies. The first half of 2007, the combined profit growth for the Shenzhen listed companies is around 80%. Even if we deducted non-occurring incomes, the operational profit is still, the growth is around 40%. If we pull together all the analysts in China's Asian market and calculate it by a market cap weighted EPS growth, we still got 40%. So basically all the three numbers have saying the same thing, that market is expecting China's listed company profit growth at around 40%. It's very solid. So basically why we believe this bull market continue to grow, because we have strong fundamentals here. Even if the economic growth slow down to 8% in the coming 2 years, we are confident that the corporate profit growth is on average above 20%. And it's in this on average 20% economic growth, profit growth, could do the selection to select companies the corporate profit growth be above 30%. So this is one of the, I think, the most solid foundations for this market to perform. The other catalyst is the renminbi appreciation. We have already stated. Basically, we're expecting renminbi continue to appreciate in the coming 2 to 3 years by 4% each year. If you look at this chart, If you look at this chart, it's basically renminbi is appreciated very slowly but very steadily. So basically, we are expecting this to continue to grow, by 3 to 5% each year. The one number we should focus is still focus on the trade surplus numbers. If trade surplus continue to grow very fast, renminbi appreciation are going to be more quicker than people expected. The third catalyst is still that more and more people are taking their money out of bank and put them in the equity market. In the past, there is a survey done by People's Bank of China, that is China's central bank, that's saying before this bull run of China's equity market, Chinese residents deposit 80% of their financial assets in the banks. But recently we have seen that people are moving their assets from the banks and put them into equity market. So that is to say more and more people are interested in this equity market. There will be more and more money flowing into it. Here I have charted that the new account opened per day and Shanghai Composite Index. Basically you can see that people are opening accounts dramatically. Although there might be exceptions, but still it's on track for the system. So that's the other catalyst that we believe are going to have short-term strong impact on China's equity market. The fourth one is that the people most frequently talk about the Olympic Games. Next year, China will host the 2008 Summer Olympics. It will be a dramatic event. This is a great opportunity to promote basically a branding opportunities for China. Basically, a lot of consumer product companies utilize and taking advantage of these opportunities to let their brand known to the international people and the domestic consumers. Here we have a historical evidence, historical statistic to say how each market perform. We have calculated the performance of the major markets which have hosting the Summer Olympics. On average, this is the year that the Olympics happened, and this is the performance around 12 to 30% in these countries hosting Summer Olympics. Before the Olympics year, that is this year, 2007, we see the market growth most. And the second year, the first year after the Olympics in Rio, was able to see the market perform. Second year after the Olympics, we see that. So this is one of the bullish about Chinese equity market. The other basis for group market is other factors is the unifying country tax. Before that, China had this super treatment for the foreign companies in China, which basically foreign companies are paying 25% income tax, while Chinese domestic state-owned enterprises paying 33%. So basically, Chinese government are lowering this 33 to 25% starting from next year. This is basically good news for the corporate profit. And also the group listing asset injection. Basically, the Chinese stock market was first started as a trial market. Basically, the government do not know what's going to happen to the state-owned companies after they get listed. They are quite suspicious when the stock market opened. But after recent years, dramatic growth of Chinese capital market, the government have known that the stock market is a good thing, and they have emphasizes that all the good assets should be put into listed companies. So we're going to see group listing asset injections still happen in the coming 1 or 2 years. The other good catalyst is the executive stock option program. Before that, most of the big companies, especially state-owned companies, they are the main profit contributor to the stock market. The management are not allowed to own the companies, so they do not have the intention of running this company well. But what they are interested in is whether or not they're going to get promoted when running this company. But even if we have this executive stock option program, they're going to pay more attention to the corporate profit growth, more attention to the stock market. So that is the other catalyst that will be bullish for the Chinese equity market. Among all these factors, Chinese equity markets are among the best performers around the world. You can see that. If you look at, they're basically, because there are two markets, the H-share market and A-share market, basically two set of indexes. If you look at A-share market, you have SSE 180, SSE 50 index, which basically is the index for the A-share market. Also, these days, the most widely followed index is the CSI 300, which is the index tracking both the stocks listed in Shenzhen and Shanghai. The performance of these indexes basically is the same. But if you look at the H-share, the outside Chinese asset class, you have the HSCEI index, which is the H-share index, and also MSCI China index, and the BONI China index. But they all return almost the same. The correlation is around 95%. So no matter which set of index you're looking at, basically you'll almost get the same returns. Here I drafted two indexes. The first is the Shanghai Shenzhen 300 index, the orange one. The other one is the HSCEI index. It's the same with the MSCI China. The A-share index outperformed the H-share index by almost 100%. So will there be a catch-up of H-share index? We would see. When we are talking about emerging markets, one of the most frequent talk about criticism is about valuations. Valuations is too expensive for the Chinese companies. Here I have compared the Chinese A-share valuations with the H-share valuations and the valuations of other major Asian markets. You can see the A-share market is the most expensive one, followed by the H-share market. Will there be a issue if you want to invest in China's A-share market? My thoughts on that is whether the H-share market or the A-share market will collapse depends on the profit growth. Take, for example, most people are saying that the H-share market, the A-share market valuation, the average PE for the A-share index is about 40 for the year 2007. If the corporate profit growth on average grow by 30%, for the 2008 PE index will be 40 divided by 1.3, it's around 29 or 30%. If the corporate profit growth continue by 30%, then the next year, that year 2009, it should be 30 divided by 1.3, it should be around 25. That was quite reasonable if you compare that valuations with the other high growth markets such as NASDAQ or the Brazil, the Indian market. So basically, what I'm looking forward is the best thing to happen for the A-share market is not the price come down, but it maintain at the current level or grow by, say, 20% or 30% each year, but the corporate profit continue to be strong so that the Asian market could start landing gradually if the corporate profit continue to grow. So this is what you see in these days. The A-share market are not A-share indexes are not rising as fast as before. So basically, for the A-share market, we are continuing to be bullish, but the upside potentials are not going to be like the dramatic rise of what has happened since 2005. But H-share is still reasonable. If you compare the 25 PE valuations with that of India, with that of Brazil or Russia, it's quite comparable. If you compare the stock market performance of China, India, Russia, and Brazil, starting from the year 2001, the market that grows the most is Russia, followed by India and Brazil. China's A-share market, even if you compare that with A-share market, China is still a laggard. So there are expensive stocks in China, but still at the market level, we are still quite confident. A-share bull run, what has happened? What has caused A-share bull run? There is the other most important factor is that one-time structural changes that have made this happen the most. If you look at the A-share market, at the end of 2005, the index is around 1,000. Currently, it's about 6,000. Within 2 years, less than 2 years, China's A-share market rise by 500%. What has caused this bull run? A couple of issues. One-time structural changes such as share reform, open market to international investors such as QFII, tax reform, the executive stock option program, all these have contributed to the A-share bull run. I'm saying this because a lot of people are asking, how come a market rise so much without too much strong fundamental growth? But because in the past 2 years, we have this tremendous project completed, and that is share reform. This has contributed a lot to the A-share bull run. For the A-share market, our outlook is expecting short-term volatilities and stable long-term growth. I've already talked about the engines and the catalysts, and we believe this A-share market are not going to collapse because a lot of institutional investors and retails have leveraged up some of them have leveraged up their positions. If the market dropped 30% within two months, there might be collapse of financial system. So we're not expecting the market come down dramatically, but the best scenario is still for the index to stay there or rise gradually, but the corporate profit growth to catch up. H-share is more attractive than A-share market. Here I have listed the PE valuations of the major indexes. If you look at H-share for 2007 is around 30%, 2008 is about 26 multiples. The A-share market is all 40 for 2007 and 36, 37 for 2008. It's kind of relatively high. H-share market. We are especially optimistic about H-share market. One question a lot of investors have asked us, do we see a bubble emerging? It depends on how do you define bubble. And if there is a bubble, are they going to burst? I mean, bubble is not a bad thing. The bad thing is it burst. I mean, the bubble are going to burst, but not now. I mean, at the end of the day, if you look at the history of investment, the bubble are going to burst, but we do not know when it's going to burst. For the H-share market, what's going to happen? Our view is still that there are going to be bubbles in Hong Kong's H-share market, and it's not going to burst within the next 6 to 12 months. So our recommendations is enjoy the bubble. The reason, I have listed 4 points. The first one is still the negative real interest rates. It's very likely because Hong Kong have this mechanism that Hong Kong does not have its own monetary policy. There is this Mundell triangle that is saying foreign exchange policy, interest rate policy, and the free flow of capital account. Once the 2 points have been determined, the other one, you cannot have the right to determine the third one. For Hong Kong, it has the target of monetary policy is to maintain the stable Hong Kong dollar rates. And also it's a international financial center. It does not control the money flow in and flow out. So basically, that leaves Hong Kong's monetary authority have no saying of their interest rates. Their rates policy is basically following that of Fed. So basically, we are expecting a slowdown for U.S. economy, and the Federal Reserve are going to cut rates. So Hong Kong's official rates are going to come down. That was determined by Hong Kong's monetary mechanism. But its real economy is following China very closely, especially in recent years. It has integrated with Chinese economy so closely that when China have inflation, Hong Kong are going, the prospect of Hong Kong have inflation is very, very big. So basically, U.S. cut the rates, but still China have inflation. So we're expecting Hong Kong are going to have a real negative rates, which is very good for bubble to emerge. And also the strong profit growth. China's economy won't slow down too much, although people are expecting it is it is going to slow down a little bit. So that is to say that when people look at profit growth, they'll say, it's quite decent. I'm still like to pay a premium for these high growth companies. So they're not going to sell it very fast. The third one is the further liquidity from China. China itself was a big liquidity generator caused by the dramatic trade surplus. The QDI program are going to drive money out of China. So we're going to further see liquidities from China. And the fourth one is valuation is not crazy. When the bubble emerges, it won't burst until it's crazy. When we talk about the Hong Kong H-share evaluations, it's still quite reasonable without the high growth market. If you look at the NASDAQ, the high growth market, the valuation is still between 20 to 25. And if you look at H-share market, it's around 25. So basically, the H-share is still, valuation is still, not crazy. So we're going to see bubble emerging in the H-share market, and it won't burst within the next 6 to 12 months. So our view is still that enjoy the bubble. Over with China, but not without risk. There is always risk associated with investing and with investment, especially investing in an emerging market. Our recommendation is to buy China stocks, especially H-shares, but don't look back. People are scared by looking back how much China's equity market have risen in the past 2 years and say this is scary. But investment in the stock market is basically looking forward what's going to happen, not look back. So don't be scared by what has happened in the past 2 years. Potential risk, a lot of risks, you know it. Benefiting from QFII and QDI. QFI stands for Qualified Foreign Institutional Investors. Basically, it allows international investors to get into the A-share market through approved quota. Basically, an investment bank could apply to the CSRC for the qualification, and then it apply through its custodian bank to the SAFE, China Foreign Exchange Administration Bureau, to get the quota, and then they could directly invest in the A-share markets. Currently, there are $10 billion worth of quota approved by the CSRC and the China's foreign exchange authorities. And all the major banks, UBS, Nomura, the first batch of companies applied for the QFII quota. Today, Goldman Sachs, Morgan Stanley, all the big banks and the foundations and the trust and investment companies, insurance companies have applied the QFI quota. And this quota are expected to expand in the coming 6 to 12 months. But because of the valuations of A share is relatively high, most international investors are not quite, especially except for those long-term investors. Short-term investors are not too crazy about this QFI quota. In the year 2005, when the Chinese A share market started bouncing back, I was a member of ING QFI team. I went to Southeast Asians and Europe to see investors. At that time, QFI investors are very enthusiastic about China's A share market. But now they're not quite crazy about it. Qualified domestic institutional investors, that is QDII. Basically, it allows Chinese domestic investors through a managed account to invest outside China's market. And we firmly believe that H share market are going to be the first one to benefit because it's close to China, it's still within one country, and the company listed Chinese investors are very familiar. After H share market, the other companies which are basically have their main business in China are going to benefit. Chinese company listed in the US, listed in Singapore, listed in the other financial centers are going to benefit because China's investors are more comfortable with the fundamentals of these companies, and it's relatively easy for them to know what has happened to these companies. So we're going to see money flowing out of China first to the H share market because they know it, they're comfortable with it, and they are cheap compared with the A share market. And then it's going to flow all the way to Chinese assets outside the country. So basically, for the good companies listed in other financial centers, they're going to be the major companies benefit from this program. And also, QDI signifies the important changes of China's image. For the past, Chinese companies are known for their cheap shirts, lighters, all the cheap labors and products. From the QDI, China has become the main international investors in the international world. So basically, we are from exporting cheap labor and products. Now we are rich. We began to export money to the outside world. So this is going to be a big change for China's country image. Currently, there are banks, insurance companies, mutual funds, and the National Social Security Fund, insurance companies are qualified QDII investors. China Merchant Securities, which is my company, are the second security firms get approved to invest outside China. We're currently preparing product launch before the end of this year. We're going to have $2 to $3 billion worth of money to invest outside China. We're going to first focus on H share market, then we may go out of Hong Kong and buy other things we like. Implication of QFI and QDI, basically first, within the next 6 to 12 months, bullish on H share market, buy any good companies which are cheap relative to the China's A share market. It's a good opportunity. That's all about my presentation. If you have any questions, I'm happy to talk about it further. Thank you.